You are listening to KSG Podcast. This is a short, crisp, concise, exam-oriented, edited editorial for civil services aspirants. In this podcast, we are going to talk about India in digital currency ownership. Source for the content is Paurush Omar's article for the Mint. The UN said that the use of cryptocurrency rose globally at an unprecedented rate during the COVID-19 pandemic, with India becoming the seventh highest country in digital currency ownership. As of 2021, 7.3% of the Indian population owned assets in the form of digital currency. Developing countries accounted for 15 of the top 20 economies when it comes to the share of the population that owns cryptocurrencies as per 2021 data. The UN Trade and Development Body, UNCTAD, that is United Nations Conference on Trade and Development, stated the figures for other countries too. Ukraine topped the list with 12.7%, followed by Russia 11.9%, Venezuela 10.3%, Singapore 9.4%, Kenya 8.5%, and the US 8.3%. The UN body published three policy briefs on 10th of August 2022, which said that while these private digital currencies have rewarded some and facilitate remittances, they are an unstable financial asset that can also bring social risks and costs. Now, brief number 1, all that glitters is not gold. One of the policy briefs examines the reasons for the rapid uptake of cryptocurrencies in developing countries, including facilitation of remittances and as a hedge against currency and inflation risks under the title All That Glitters Is Not Gold, the high cost of leaving cryptocurrencies unregulated. The brief also mentioned the risks of digital currency, stating that recent digital currency shocks in the market suggest that there are private risks to hold crypto, but if the central bank steps in to protect financial stability, then the problem becomes a public one. Highlighting the vulnerability of the digital assets, it said, and I quote, "If cryptocurrencies become a widespread means of payment and even replace domestic currencies unofficially, this could jeopardize the monetary sovereignty of countries," unquote. In developing countries with unmet demands for reserve currencies, stablecoins pose particular risks. For some of these reasons, the International Monetary Fund has expressed the view that cryptocurrencies pose risks as legal tender. Now, brief number 2, public payment systems in the digital era. The policy brief titled Public Payment Systems in the Digital Era, responding to the financial stability and security-related risks of cryptocurrencies, focuses on the implications of cryptocurrencies for the stability and security of monetary systems and to financial stability. The brief said, "It is argued that a domestic digital payment system that serves as a public good could fulfill at least some of the reasons for crypto use and limit the expansion of cryptocurrencies in developing countries." It further stated, "Depending on national capabilities and needs, monetary authorities could provide a central bank digital currency or more readily, a fast retail payment system." UNCTAD urged authorities to maintain the issuance and distribution of cash since there is a risk of accentuating the digital divide in developing countries. Now, brief number 3, the cost of doing too little too late. The third policy brief titled The Cost of Doing Too Little Too Late, How Cryptocurrencies Can Undermine Domestic Resource Mobilization in Developing Countries, discusses how cryptocurrencies have become a new channel undermining domestic resource mobilization in developing countries. While cryptocurrencies can facilitate remittances, they may also enable tax evasion and avoidance through illicit flows, just as if to a tax haven where ownership is not easily identifiable. Cryptocurrencies may also curb the effectiveness of capital controls, a key instrument for developing countries to preserve their policy space and macroeconomic stability, it said. UNCTAD urged authorities to take actions to curb the expansion of cryptocurrencies in developing countries, including ensuring comprehensive financial regulation of cryptocurrencies through regulating crypto exchanges, digital wallets, and decentralized finance, and banning regulated financial institutions from holding cryptocurrencies or offering related products to clients. Considering the new challenges digital currencies can pose, it also called for restricting advertisements related to cryptocurrencies as for other high-risk financial assets, providing a safe, reliable, and affordable public payment system adapted to the digital era, implementing global tax coordination regarding cryptocurrency tax treatments, regulation and information sharing, and redesigning capital controls to take account of the decentralized, borderless, and pseudonymous features of cryptocurrencies. That's it for this podcast. Thank you so much for listening. To join KSG India courses and to crack the IELTS exam, visit ksgindia.com. You can also get a PDF of this podcast on ksgindia.com. Thanks for listening.